Hong Kong, Reuters. Hong Kong bankers are eyeing a slew of blockbuster IPOs from Chinese technology firms with a total market capitalization of some $500 billion over the next 2 years, in a sharp contrast to 2017, the city's worst year for raising equity in a decade. If bankers' expectations are met, it would set up Hong Kong for a showdown with New York, the traditional host for the world's hottest new economy companies and Hong Kong's closest rival for the global IPO crown. Companies such as smartphone maker Xiaomi, IPO XMGP, HK, and wealth management platform Lufax are among those mulling multi-billion-dollar listings in Hong Kong next year, encouraged by a late 2017 rush of tech floats. Bankers estimate Xiaomi's IPO could value the company at up to $100 billion, while Lufax was valued at $18.5 billion in its last funding round. The expectation is that over the next couple of years there is probably upwards of $500 billion of market capitalization just in the tech sector in China that could go public, said Tucker Highfield, head of Equity Capital Markets Syndicate for Asia Pacific at Credit Suisse. Some firms will still head to New York, whose acceptance of dual-class share structures is attractive for many technology companies. Meituan Dianping, a Chinese platform for ordering food and booking is expected to choose New York for a float that could raise $3 billion. But Hong Kong, the world's biggest equity capital raising center for 4 of the last 10 years, is looking to revive its appeal and this month announced plans to allow dual-class shares as it tries to attract Chinese tech listings. Hong Kong raised $32.8 billion in equity capital in 2017, Thomson Reuters data shows, the lowest since 2008 when fundraising dried up during the global financial crisis. Of this, IPOs accounted for $10.9 billion or just more than half 2016 levels, leaving Hong Kong ranking 4th globally for 2017, behind the New York Stock Exchange, Shanghai Stock Exchange and Mumbai's National Stock Exchange. Distracted investors, bankers and investors said the dominance of Wall Street in the first half of the year, when a series of record closes for benchmark indices grabbed headlines, distracted global investors from an even stronger rally in Asian emerging market stocks. Hong Kong's blue-chip Hang Seng Index, She has gained 35% this year, its best performance since 2009. MSCI's broadest index of Asia-Pacific shares outside Japan, MIAPJOOOPUS, has risen over 32%. MKTS, Glob. The city was also hit by the timing of some giant floats, such as an IPO of up to $10 billion by China Tower, the world's largest collection of telecoms towers, that was expected in 2017 but is now seen happening in early 2018. Spurring the current optimism are a series of recent hot tech floats. China Literature 0772 HK raised $1.1 billion in November and jumped more than 80% on its debut, the best opening pop by any big IPO worldwide this year. The backlog is strong, said Aaron Arth, head of the financing group for Asia excluding Japan at Goldman Sachs. There are a number of big deals likely to come to market that are backed by strong business dynamics and exposure to China, all at a time when people are reallocating to the region. Arth added. Equity raising across Asia-Pacific slipped 2% this year to $236.3 billion, its lowest since 2013, as sales of additional equity by listed groups fell 14%. Morgan Stanley, Mizuho, UBS, UBS-GS, and Goldman Sachs, GSN, led the equity league tables for the region with $13.6 billion and $12.4 billion and $12.3 billion of deals to their credit respectively. CITIC Securities, 600,030, SS, and Citigroup, C.N., rounded out the top 5. Reporting by Jennifer Hughes, editing by Hamani Sarkar. Standards. The Thomson Reuters Trust Principles.